I want to go over. Number one, we're going to talk a little bit about Pfizer. I think Pfizer has found a bottom. We're going to go over the technicals, go over what Moody's rates Pfizer as, and where my thesis is on Pfizer. Along with that, we're going to talk a little bit about the Paramount issues or Paramount takeover that's now taking place, where my analysis was on Paramount. And then also, I want to talk about running options or using options to build into positions and writing calls against positions. There's pros and cons to doing this. It just really depends on what you're trying to accomplish. Now, as always, ladies and gentlemen, I always recommend just dollar cost averaging into a broadly diversified index. Set it, forget it. But for entertainment purposes and for what I'm trying to accomplish in this market, I am taking on a lot of risk. And this is risk that I'm willing to take on. And so you guys can follow along with me on building in these positions and either see if I fail or if I succeed. So hopefully you guys enjoy, appreciate that. I always appreciate anybody that can give me a thumbs up. Consider subscribing, because what I think I'm going to do going forward is actually do some market closes here together. We're going to build a watch list together. I want to go over that as well. So I'm going to try to make this as efficient, as quick as possible, but also want to go over some of the expectations going forward on the channel and kind of what I want to start accomplishing here. Now, if you're new to the channel, welcome in. We take a fundamental approach and also look at long-term price action. So we always believe on this channel, price is what you pay, value is what you get, but also the trend is your friend. So we try to combine all that together and give you a balanced investment approach. So with that being said, let's get into Pfizer right now. First thing I want to pull up is complete transparency on my two largest positions. Pfizer being number one now after the recent rally, basically getting in around 25 and change, $26. And Cisco, my number two holding. Now, Cisco to me is a low, steady, set it, forget it. This is going to have long-term upside opportunity, but now is the accumulation phase for Cisco. We can possibly touch on Cisco as well, but mainly I want to stay focused on Pfizer. I want to show you guys kind of where Moody's rates Pfizer, where their price action is, or where they see price coming in for Pfizer. And then I also want to go over the chart, because the chart is making an interesting formation to where I do believe we're starting to see a bottom in Pfizer, okay? So obviously nothing's ever a guarantee when it comes to investing, but I do want to go over all this with anybody that's interested in listening. So oddly enough, very different opinions about Pfizer. Some people love it, some people hate it. You have price ranges anywhere between $25 all the way up to $45. Currently, the stock is definitely closer to that $25 range, sitting at $28.41, paying a 6% dividend, which makes me a little bit nervous when we look at the payout ratio and what earnings expectations are. I'm not buying it for the dividend. I'm buying it for the future value of what I think they can unlock here. And oddly enough, when we look at Schwab rating, it gets a C grade on Schwab rating is a C grade on Pfizer, okay? So ranks in the 37 percentile, which is actually pretty decent. But when we go down to Morningstar, Morningstar is pretty much in line with me. Now, this is pretty recently updated, only a few weeks old. And where they kind of see the stock price going, they believe fair market for Pfizer is $42, okay? So currently, when they wrote this article, the price closed at $27.42, and they believe fair market value for Pfizer is sitting right around $42. Now, we've talked about this numerous times on the channel. When we deal with these drug makers, it is a cyclical type of business. They're hot one minute, they're hated the next, okay? But when we look at valuations and kind of the class that Pfizer's in, it's definitely trading for a substantial discount, and rightfully so. It has a lot of debt. It's made a lot of it has a lot of things expiring off of its patents, and so there is some questions here. But you also have to remember that this company's dealt with the ups and downs. And I do think that they are building out their pipeline, and the acquisition of CGen will eventually pay dividends. So where they kind of build their thesis is more forward-looking on Pfizer's foundations remaining solid based on cash flow generation and a basket of diversified drugs that are coming in the future. Okay, and so that's where they get their $42 price target. Now, when we buy stocks, we want to look more contrarian, because if we're looking at stocks that are very popular or that's being covered if it's being covered immensely in the market, you're going to have price perfection already in the stock, right? You're probably going to have to overpay to even get involved. So what I like to do is I take a contrarian approach to investing. So when everybody's talking about, a Nike, or everybody's talking about one of these weight loss drugs, I'm looking at maybe an Under Armour, or I'm looking at maybe a PFIZER, okay? A company that's fallen 50, 60%, but still has tremendous opportunities ahead. So that's where I tend to go to, because that's where I think the biggest opportunities lie, okay? So what I want to do is just go over the technicals with PFIZER. Right now, I believe we're seeing a head and shoulders pattern, a reverse head and shoulders pattern formulating in PFIZER right now, okay? So what does that mean for you? That means that there could be a bottom formulating here. So I see a left shoulder right here, a head where we hit the low of right around $25, and now we have another shoulder formulating here, and it looks like it's going to try to break out of this consolidation period that it's been in for multiple months right now. Okay, this is a 3-year chart, this is a weekly chart, so this has been multiple weeks of it basically trading sideways between, call it $25 and $29. Okay, so it's been in a tight range for an extended period of time, and I believe it's trying to break out of this range, and we're starting to get a formulation here on the chart saying that maybe PFIZER has actually hit a bottom with this reverse head and shoulders pattern, and now it's starting to break above major moving averages, which is the first signal that we could be looking at a bearish to bullish reversal. Okay, so when we bring it down to a 1-year chart, it is now moving above all major moving averages. Okay, the blue line is going to be the 200-day moving average. For me, I use a 180-day moving average. I use all my moving averages in time periods of investment. So I look at 3-month moving averages. I look at a weekly moving average. Basically, anytime we're looking at quarterly reports or anytime we're looking at quarterly movements, that's how I like my moving averages to go. Okay, so I tend to do something a little bit different with my moving averages. They're a little bit lower than most moving averages. So what I see here is above all major moving averages, and it's consolidated here, and it's forming some sort of W pattern, which we know tends to be bottoms. So we can see a W pattern here, which that was the recent bottom, tried to break out and created a double top here, sold off, and now we're getting another W pattern formulating, which means that it could be possibly getting some buying pressure and starting to move up. Maybe the worst is over when it comes to investment sentiment for the stock. Okay, so that's kind of just a quick review on the technicals. Now what I want to just brush over really quick is going to be we're going to take a look at a couple different things here. There's a couple stocks that I'm personally getting interested in, but also I want to show you guys a few different things here. So after today's close, PFIZER closed with a $160 billion market cap. Okay, enterprise value sitting right around $200 billion. Okay, I just want to show you guys something that's pretty interesting here. Because while everybody's jumping on hype trains, I tend to think that there's strong fundamentals in a lot of companies that are getting overlooked. And, I definitely think there's a risk versus reward when it comes to PFIZER, guys. This is not, let me tell you something, this is not a slam dunk investment. This is a high risk, high reward. Most of the stocks that I'm going to be talking about are higher risk, higher reward type of stocks. And they're not stocks for everybody, right? But there's tremendous amounts of upside in a company like PFIZER. Reason being is this is a company that should probably be trading between $35 and $40 a share, in my personal opinion, and it's trading, almost 30-40% off, not including reinvestment of dividends, which is nearly 6%. Okay, so we could be looking at close to a 45-50% undervalued asset here. So the thing I want to show you guys is kind of where the revenue is right now, and this is basically kitchen sink revenue right now. So I want to bring that to your attention. So basically, PFIZER gave us kitchen sink earnings. The worst is basically here. Hopefully the pipeline builds out. Hope is not a strategy, but we hope that management's going to start executing. The pipeline's going to be built out. Yes, they got rid of the mergers and acquisitions, the person that headed the mergers and acquisitions, but that's not a huge deal because what they stated was they were going to stay focused on just implementing the mergers that they've already made and making them profitable. So at this point in time, we're probably not going to see a lot of transactions for PFIZER anyway. So that replacement should be a smooth replacement. But when I look at what they earn, so basically they're doing right around they're doing right around 50 to 60 billion dollars in revenue. Okay, we bring it down to a free cash flow standpoint. And free cash flow is coming in light because of the recent acquisitions. So right around $5 to $6 billion of free cash flow. But once again, this is a company that's probably going to do closer to $15 to $20 billion of free cash flow once things normalize. Okay, that's something we can expect. Even if we go on the low end and say $10 to $15 billion of free cash flow. Okay, so now I want to compare that to like an Eli Lilly. Okay, so we see that they're doing right around $50 to $60 billion of revenue, and they could probably do anywhere between $10 to $15 billion of free cash flow. Now, Eli Lilly is trading for nearly $840 billion. Eli Lilly is doing $35 billion in revenue. Okay. So Eli Lilly literally trades for 4 times the valuation that Pfizer's trading for, and they're probably going to be doing similar revenue this year. Okay, so Eli Lilly's probably going to be pushing the high 40s to low 50s in revenue, but it's trading for 4 times the valuation that Pfizer's trading for, right? And then when we bring it down to a free cash flow standpoint, Eli Lilly's making acquisitions, they're spending, but they're probably going to do between, call it $5 to $10 billion of free cash flow. So I'm looking at this and I'm seeing that to me, Pfizer looks like an interesting opportunity. Yes, it's got high risk. Yes, it's got high reward. But when we start comparing them to their peers, or we start comparing them to other companies, when we bring it down to a natural valuation standpoint and a true fundamental standpoint, I don't know how you can't get excited about buying a company that's trading for $150 billion valuation. And when we factor in debt, maybe a 200, 220 enterprise valuation, and we compare it to an Eli Lilly that's trading for nearly $1 trillion valuation, and yet the fundamentals and revenue could be stronger for a company like Pfizer. And so this is the disconnects that are taking place within the market that I just think are pretty big opportunities. And yes, they're priced for a reason, okay? There's a reason why that Pfizer is being priced so much cheaper than an Eli Lilly, right? It doesn't have the sexy pipeline. It doesn't have the growth that's happening. Eli Lilly's on the upward trajectory. Pfizer's on the downward trajectory. But what did we see through COVID? That trajectory can change in an instance. When COVID happened, Pfizer's stock skyrocketed because of the COVID vaccines. Eli Lilly is now the hot stock because of the weight loss access, right? And Pfizer's falling to the hip side because the vaccines are falling off, but they don't have anything in their pipeline that's going to come recently. Now, if we think fast forward another 5 or 10 years, the acquisitions that Pfizer has made, if they pay off, could we be looking at a multiple that's closer to Eli Lilly, where it's trading for 500 billion to 600 billion market cap, which would be nearly a 2 to 3x, right? And so when we're comparing kind of the true fundamentals of each company, I definitely think there's opportunities that are kind of just getting completely overlooked. And this is not how you measure stocks, guys. I'm just showing you that I do think there is some pretty big disconnects that I'm looking at here. And I just think that when there's fear in the streets, you have to start looking at some point at some of these stocks that have sold off significantly. Okay, I want to touch on Warner Brothers Discovery. Now, when we did our valuations on, and I want to make sure that I'm not just blowing smoke, so I want you guys to see exactly what I'm talking about so you don't think I'm just blowing smoke here, but I should be able to pull it up. And guys, give me a thumbs up if you're hearing everything okay. I just want to make sure everybody's good. So when I did a valuation on both Warner Brothers Discovery, so I want to pull up Warner Brothers Discovery here. To me, high risk, high reward once again, okay? That's definitely not it. That's Dutch Brothers. Warner Brothers. Where are you? Okay. So when I look at Warner Brothers Discovery, once again, high risk, high reward, okay? This is sitting around a $6 to $7 stock. I have a price target of $6.87. On the recent dip, I have added into Warner Bros. Discovery. All right. To me, I think around the $6 to $7 mark makes a lot of sense. And then when we compare what they can accomplish to a Netflix, I think it's going to surprise you guys here. Now, of course, they have a heavy amount of debt. Okay, that's the whole downfall with Warner Brothers Discovery, right? The debt is the debt load is the problem with Warner Brothers Discovery. But what I want to show you guys is when we break down what they're doing for revenue, and kind of we're still early in the streaming games. This is anybody's game to still win, and I truly believe that Warner Brothers content is actually very, very competitive, very solid, and I do think that they're going to acquire an audience even without live sports that a lot of other streaming companies can't really do. Let's see here. Sandy, that's awesome. Thank you for chiming in. So Eli Lilly has a game changer drug, but what's the long-term effect of that drug? And that's kind of been my thesis on it too. We really don't know. A lot of her relatives have lost significant amount of weight. So that is absolutely awesome to hear. And the type of excitement and type of things that you're talking about now about Eli Lilly, could that be something we're talking about Pfizer in 5 or 6 years, that they do have remedies for cancer? And maybe there's other things in their pipeline that they're working on as well. But definitely cancer is kind of where they're front running, right? So definitely thank you for sharing that. But what I wanted to point out when we talk about Warner Brothers Discovery, yes, this is one that is a distressed asset. I guess when you think about me as an investor, guys, I'm not going to sugarcoat it. I love distressed assets. I love distressed assets that are being discounted by the market that I think still have some fundamentals underneath them that could actually be an absolute competitor. Okay, so if everybody's wondering why I'm not talking about the most popular stocks are probably priced to perfection. So I tend to look more contrarian, more distressed assets. Okay, and when it comes to distressed assets, there's really not many more distressed assets than a Warner Brothers Discovery and a Pfizer, right? Being down 50, 60%. Okay. The question now becomes, at what price does it make sense to take on the risk? And when do you cut your losses? And when do you take profits and all that good stuff? So, and we do talk about that on the channel. Back to Warner Brothers Discovery. Basically doing between 40 to 41 billion in revenue. Okay. Now, when we bring it down to a free cash flow standpoint, this is a company doing between $6 to $7 billion in free cash flow, right? Yes, they are still trying to make streaming more efficient, more profitable. All that's still in question. Okay, no, I'm not going to deny that. But I just wanted to show you kind of the meat and potatoes of what we're looking at here. Okay, they're doing nearly 41 billion in revenue and free cash flowing right around $6 to $7 billion. Where's the valuation in Warner Brothers Discovery? Market cap sitting right around $17 billion. I believe I got it around $16 billion. But then when we bring it down to an enterprise value, when we factor in all the debt that they have, we're looking at a company that's trading at $57 billion valuation. Okay, I like to use enterprise value, guys. The reason why I like to use enterprise value is because enterprise value is going to factor in debt. Debt is extremely important in this economic cycle. I want you guys to understand this. You need to be looking at debt loads when you're buying stocks right now. With a higher interest rate environment that we're in, we're watching a lot of small companies lose liquidity and go bankrupt. Why is that? Because the cost of capital has gone up and the businesses are not running as efficient due to inflation. So they're catching it from multiple ways and they go under. Now with Warner Brothers Discovery, they have enough cash flow, I think, to get this debt load down. They've been aggressively paying it off. And they're being more responsible when it comes to financing, right? They're probably not going to be putting an NBA bid in because they want to save those billions of dollars to possibly pay down debt and look at more longer term content that they can keep in their library and keep it proprietary. So when we look at Warner Brothers Discovery trading at call it a 50, we'll round it up here just for even numbers, guys. Companies doing right around $6 billion in revenue. Enterprise value companies doing right around $6 billion in free cash flow. 41 billion in revenue. Enterprise value is sitting at $57 to $60 billion in enterprise value. Now, when we compare that to a Netflix, I think you guys are going to be pretty surprised at how comparable this is going to be. Okay. Netflix is trading for nearly $300 billion market cap. Okay. So when we bring it to an enterprise value, because I do want to factor in the balance sheet, okay, they're trading exactly at $300 billion of enterprise value versus Warner Brothers Discovery trading at $60 billion. So that is a 5x difference in valuation. Netflix is worth 5 times more than Netflix's enterprise value is worth 5 times more than Warner Brothers Discovery enterprise value, right? But when we bring it down to the finances, Netflix is doing $34 billion in revenue. Okay, so right off the bat, Netflix is worth 5 times more in enterprise value, doing $7 billion less in revenue. Like, let that sink in for a second. Netflix is 5 times more valuable on an enterprise basis, doing $7 billion less in revenue. And that's what, roughly a 30%, roughly a 25% decrease in revenue, but worth 5% more. Okay. When we bring it down to a free cash flow standpoint, the free cash flow is comparable. The free cash flow is sitting at $6.9 billion. Well, we just showed you that Warner Brothers Discovery is doing between 5 to 7 billion in free cash flow. So I'm looking at these opportunities, and yes, they're being priced for a discount for a reason, right? A lot of liability, a lot of unknowns in the future. Netflix's future is a little bit more stable, a little bit more well-known, cleaner balance sheet, not as many headwinds. But when we break it down to just kind of meat and potatoes here, this is not what we need to be looking at all over. Like, this is not everything, but this is just showing you kind of the disconnects that I think are personally happening within the market. I'm looking at companies that are doing comparable revenue, that could have comparable fundamentals, that are trading at ridiculously cheap valuations, and rightfully so. But does that mean that these companies are going to fail? And it's going to come down to a few different things, right? Execution and management. Those are two things you kind of have to take into consideration. So when we think about what we're kind of betting on at this point in time, I think we have to start looking at risk versus reward. Things are getting expensive. Where are other areas that we can kind of take a look at that might make sense from a risk versus reward standpoint? So if Netflix was to have a 30% pullback, is something like Warner Brothers Discovery already priced in that pullback? Like, is it going to falter as much as a Netflix? And I just don't think so. I think the bottom is probably closer in for those types of companies. And then when I look at kind of where the fundamentals could start picking up, these are companies that are pretty comparable or comparable from a revenue and free cash flow standpoint that make them pretty interesting as far as a long-term distressed asset that could actually be what we call a turnaround story, right? So there's 4 different phases of when we think about stocks. There's 4 different phases, or 4 to 5 different phases we can think about. And turnaround, slow growth, you have high growth. So there's multiple phases within a cycle of a stock or a cycle of a business that we need to consider. And most of these are definitely turnaround stories. So higher risk, high reward. But when we look at the fundamentals, definitely pretty interesting on that standpoint. Want to touch on a stock really quick. And before I do, I kind of want to breeze through. So it looks like Paramount's going to get a $15 bid on B shares. And I think it was a $23 bid for A shares to get taken over by, I believe it was Skydance. So I believe that was the deal that was done. I still hope that I have the analysis up here. I don't know. Anyway, we'll make a long story short. I definitely did an analysis on Paramount Pictures, and I came up with a price target of right around $15 a share that I thought made sense for Paramount Pictures. So if I were to buy the stock, I would have needed to buy it for $8 or $9, which it did hit those levels to get a compounded rate of return, and then ultimately in a 7 to 10 year window, be looking at closer to a $15, $16 stock. Okay. What did they get bought out for? They got bought out for $15, which just shows that these fundamentals do end up equating to, as long as you're running your numbers with realistic expectations, these fundamental analysis can actually help you in guiding you to where a stock price should be versus what the market is pricing it at. So when we think about, just to kind of pull up an example, ladies and gentlemen, I brought up PFIZER earlier in this video. If you missed it, go back and watch it. But basically, I want to pull up PFIZER here because Morningstar thinks that PFIZER is between a $40 to $42 stock. And I'll show you kind of and walk you guys through my analysis on that one. So where is PFIZER? I have so many analysis that I've done. Sometimes it's hard to find. This is one that should, there it is. Okay. So you guys can see right here that ideally PFIZER to me was around a $24 to $25 stock. Okay. So I put $24 here, built some safety in there, but my fair market value for the stock is closer to $50 a share, which kind of supports Morningstar's view on PFIZER's long-term outlook, right? Being a $42 stock, probably in the next 3 to 5 years, well, is it unrealistic to think by 2031 that it could be closer to a $50 stock? And that's basically where my expectation is for the company. Now, this might not be a popular view on PFIZER, but personally what I think they should be doing is possibly slashing the dividend in half and making more acquisitions, getting really, really aggressive on mergers and acquisitions, getting really, really aggressive on research and development, building out the pipeline for long-term free cash flow generation, for long-term growth, and basically not missing a beat over the next 10 to 20 years. And so in the short term, I think it makes more sense, instead of paying out these dividends, to actually reinvest in mergers and acquisitions, to actually reinvest in research and development, building out that pipeline, bringing down the debt, and doing those types of things that are actually going to generate more stock appreciation in the future than paying out a short-term dividend that's, I think it's like $4 billion a year they pay out in dividends. But that $4 billion could actually, that $4 billion could buy a lot of these small biotech companies right now, right? Especially with the recent sell-offs. And a lot of these biotech firms don't have the liquidity that they once did at 0% interest rates, right? So it makes the mergers and acquisitions much more aggressive on companies like the Eli Lillys, on the PFIZERs, and things of that nature. So, that's personally what I would like to see longer term. I know in the short term, the stock would probably not do so well because everybody buys it for the dividend. But when we think about this could be a stock that if it got rid of the dividend and really got aggressive on mergers and acquisitions, paying down debt, we could be looking at, a $600-700 billion stock comparable to an Eli Lilly trading at $900 billion. And that would be, a 3x return. So that's the difference, that I personally would rather see longer term in that company. So we'll hit up on a stock that I think is actually getting pretty interesting here. If you're interested in AI, this seems to be like it could have some AI capabilities in it as well. This was a darling during the pandemic. Kathy Wood loved it and then dumped it. And I just started looking into it, and I'm going to be talking about Zoom videos. Okay. So if you're not familiar with Zoom right now, basically, they do video communications, right? So, they're probably one of the most popular next to Teams and Zoom basically own the space. And definitely Microsoft is taking a market share away, and that's being priced in the stock when we look at kind of where it's been, right? So we think of the peak of the pandemic here, guys. This was $559 stock that has fallen from Graceland and is now trading at $56 a share. Okay, there is really good fundamentals behind this stock. Very, very good fundamentals behind the stock. Okay, currently trading at a PE ratio sitting around 20 times, forward PE sitting right around 11 times. Okay, and where this stock is actually getting interesting, or where I think the opportunity is actually within the balance sheet. The balance sheet is very, very interesting here. So while the stock is being discounted substantially, they are investing in AI. I don't know how the AI is going to play out for them. A lot of it's based on sound, muting sound around an individual, changing the background. They're doing unique things, but it's not moving the needle for the company. But the balance sheet and the position is where I think the company is very interesting. I think we're still in early stages of communication being on video. And I had a long conversation with my friend today about this. Let me put it to you this way. And we're going to go over the balance sheet in a minute, but I kind of want to talk through some things. Sometimes companies get overlooked because they become boring. Okay? And I always use Microsoft as kind of the staple when I use these types of stories. Microsoft had a phenomenal balance sheet. Microsoft had Windows, and it was a very, very, very boring stock. Actually, let's pull up a long-term chart of Microsoft. So I really want to point out Microsoft right in here, ladies and gentlemen. Basically, from 2000 to 2015, from 2000 to 2015, Microsoft in a 15-year period was a flat company. Okay, let that sink in for a minute, because look at the exponential growth that it had following. All right. So Microsoft was a pretty boring company basically through the dot-com bubble and all the way up to 2015, 2016. And then it had this massive exponential growth because it invested and it had a great balance sheet and it had a great outreach, right? It had a moat. Okay, it had a moat that was basically could build on top of build on top of build on top of build. And it had a moat that outreached to people that were spending money, business owners, right? And that moat turned into something special in 2015, 2016, and beyond. They made great acquisitions. They made tremendous research and development. They spent tremendously on research and development because they had a phenomenal balance sheet. And they were positioned well. Okay, now I'm not saying I actually think Cisco's probably closer to a Microsoft at this point in time than a lot of other companies with the investments that they've made, and I think they're uniquely positioned. But when I think about an AI company that's kind of getting overlooked, here, and I think about falling from Graceland and just kind of contrarian, Zoom Videos kind of hits on all of that. Okay, so let's talk really quick on Zoom Videos. I want to talk about how I've kind of approached this one as well. So 11 times forward earnings is historically cheap for the company. And a lot of people are counting out growth factors. But the odd thing is that I still think we're in early stages of technology communication and people doing meetings from home. I think there's going to be an accountability factor. I think more and more people are going to work from home. More and more business transactions are going to be done from home probably. And I think we're still in early stages of that, where we could actually be having Zoom meetings while our Teslas are driving us to different locations. Like, we're still in early stages of this. So I don't know what technology can come from this, but what I will say is that they're uniquely positioned, which means that they have a nice audience that is spending money on their platform. They have good fundamentals and they have a tremendously strong balance sheet. The question now becomes, where does this investment go? Where could they make the next acquisition to really change the growth trajectory of the company? Because when we look at the company, it's still growing. Yes, it's not growing as fast, but sometimes companies take a breath. Sometimes they have a disappointing year or two, and then there's reacceleration, and then there's re-innovation, and we start seeing that acceleration take place again. Now, for a company that does, I actually like using Yahoo's, I think Yahoo's more up to date than Stock Analysis on the finances, so I'm going to use Yahoo. So when we look at the market cap, and what did we talk about earlier, ladies and gentlemen? We talked about enterprise value, right? Factoring in debt, okay, factoring in the balance sheet. So when we look at the market cap of the company, the market cap is sitting at $17 billion, okay? Market cap is sitting at $17 billion, all right? This was over a $500 stock, now trading in the 50s, okay? So market cap set 17 billion, but we want to talk about enterprise value. We want to factor in their balance sheet. So when we look at their balance sheet here, and we look at enterprise value is at historical lows. So market cap sitting at 17.5 billion, enterprise value is sitting at $10 billion. What does that mean to you as an investor? That means that the company has $7 billion of net cash just sitting on the sidelines. So when I'm buying this company at $17 billion valuation, and this is kind of how I explained it to my friend. If I'm buying this company at a $17 billion valuation, right off the bat, I'm getting $7 billion back in cash, straight cash, without any hesitation. So the minute I put $1 in this business, I'm getting that $7 billion of exposure to where management is going to either A, buy back stock, B, reinvest in the business, C, make acquisitions, D, pay a dividend. So there's multiple things that they can do with this $7 billion sitting on the sidelines. This is a very, very good balance sheet, guys. When we bring it down to a financial standpoint, okay, they're doing $4.5 billion in revenue. Okay, nothing great there. But when we bring it down to a free cash flow standpoint, guys, they're doing $1.6 billion in free cash flow. So now let's add one more step to it. If I told you today, guys, you can buy this business, let's just use realistic numbers here, okay? I'm going to let you buy my business for $17,000. And when you buy my business, I have no debt, and in the business account, there's $7,000 sitting in there. Not only is there $7,000 sitting in there, but every year my business is going to make you between $1,500 and $1,600 every year. So think about that really quick. The minute I buy this business, I basically get a huge chunk of my investment back in cash. Yes, it's in the business account, but it's still sitting there for me to disperse and try to get a rate of return on, right? On top of that, over the next few years, I'm basically going to be able to rebuy another business for the same cost. So if I'm getting $1,500 every month, if I'm getting $1,500 every year, and I'm getting a check for $7,000, but I'm only buying the business for $17,000, then I only need to wait about 6 years to repurchase another business just like this. So when you break it down to kind of simplistic terms like that, I don't know many people that wouldn't buy a business like that. Now we factor in that they have a pretty good moat. It's not a tremendous moat. It's not a Microsoft. It could be losing market share. It's definitely losing growth. It's losing some steam. But they have a pretty substantial moat to where a lot of people, when they're using video work-related meetings, are using Zoom. And so pretty good brand recognition, pretty good moat, not the best, but pretty good. When we look at the balance sheet, very clean balance sheet, tremendous fundamentals. When we break it down to a free cash flow standpoint, every dollar that they're bringing in is basically a huge percentage is coming down to bottom line. So when I look at this opportunity, the question now becomes, can management execute? Do they really have true AI capabilities that we're overlooking. And my imagination, I'm not that intelligent to answer a lot of these questions. My imagination can only run so far. I'm very analytical, so I'm usually not the best at this kind of things. But I start thinking of other directions they can go, okay? And I can give you a quick synopsis. What if you have a meeting and there's AI capabilities within that meeting that if someone else misses that meeting that was supposed to be there, whether they're sick, whether they were in traffic, they couldn't get to their computer, they had a black outage. What if all of a sudden they get an email with all highlighted notes that were relevant to them in that meeting that they need to accomplish or need to get done, but because they weren't in that meeting, nobody has to manually do this. It gets automatically emailed to them. The next meeting is already set up for them. Like, there's many different ways that they can kind of start separating themselves and using technology that is very simplistic, but also could also bring a competitive advantage to this moat that is substantial. I wouldn't say it's meaningless. I definitely think when people think about video business meetings, the first or second thought is going to be, Microsoft Teams, and then right behind that's probably going to be Zoom. So I just don't know if the story just in their core business, I don't think the story is completely dead in their core business just yet. Not only is it not completely dead, but I also believe that with this clean balance sheet, the free cash flow, and the amount of cash still on this balance sheet, that they can do something substantial. That substantial move needs to pay off though, right? That's where the risk comes in. That substantial move needs to pay off. What kind of acquisition is that going to be? Really don't know, but do think they're uniquely positioned. I do think they have a clean balance sheet. And I do think this is a company that is starting to get to an interesting point. So now I might just end it there, guys. I'm not sure if there's any questions. I know there's not a lot of people in here, but wanted to kind of go through ins and outs. I'm probably going to do a video on a few different stocks that I think are getting pretty interesting. I think I named a few right now, but here's what I want to do. If anybody's really interested in this, I think what I'm going to end up doing is go live after hours, right after the bell, maybe during the bell, between 3:45 and 4:45, maybe 5 o'clock. I'm pulling up something here. And the reason why I want to start doing that is when we see companies sell off or we see opportunities within the market, I want it to be fresh in our heads. And I want to have an open conversation on a live stream and start creating a substantial watch list. So let me give you an example of what I mean. So ideally, what I want this watch list to do is I want this watch list to have a few different things in it, okay? Number one is that we have to run an analysis on it, and it has to seem substantially undervalued, okay? That's number one. Number two is it has to have fundamentals that we can calculate, meaning it has to have revenue, it has to have free cash flow, it has to have a decent balance sheet. We can't just put up companies that are hemorrhaging money up there, okay? So for example, and I'm going to rate these guys. This is the goal. The goal is to get about 20 different really not high risk, 20 different names up here that are quality names that have a good opportunity, not good. We don't want good. We want great opportunity. That have great opportunities that could really be multi-baggers, okay? So, for example, I'm going to put Zoom up here, okay? I'm not saying this is number one right now, but I'm just using this as an example, okay? So, for example, if we start taking this serious, we could put Zoom up there and we can run an analysis together on the channel. And I could say, at $49, Zoom is where the risk versus reward makes sense because we ran our analysis and the chart is starting to find a bottom. And we're going to try to line up the fundamental long-term technicals with some decent fundamental analysis, right? And so we put Zoom up there because, well, Zoom could be, a $50, $60 billion company. And if we look at that from a multi-bagger standpoint, that's a 4x stock. It's a 4x stock. That means that the stock could be trading for like $220. And right now it's sitting at $56. But if we buy it at $49, maybe it's a 6x stock. So these are kind of the names that I really want to start focusing in on, just because I think when we look at what's being pushed out on YouTube, when we look at what's being pushed out on mainstream media, these are really not names that are being talked about. And I like that, because these are names where it's not being pumped up. There's no price recognition yet. I basically want to get there before the market realizes it, because once the market realizes something, it gets expensive, and that's when you kind of miss the multi-baggers. That's when you miss the opportunity. When mainstream starts talking about certain stocks, you've probably already missed the majority of the run. So I definitely think Zoom could be up there at some point in time, but I'm just using this as an example. We talked about PFIZER, okay? That could definitely be up there. PayPal could definitely be up there. We talked about Warner Brothers Discovery, I think around $6.50, So I'm just using this as an example, but this is kind of where I want the direction to go, because I think this is where there's big opportunities. And if we work together and we kind of use this as a voting system, and there's things that I'm missing, because when you're covering a lot of stocks, there's going to be things that I'm personally going to miss, guys. I'm not going to catch everything. Maybe somebody can bring it up in the chat that I overlooked. I can dig into it, make sure that it's correct. But it'll allow us to kind of have some checks and balances, and it'll allow us to kind of start building a watch list. And I can give you guys the link to that watch list so we can update it maybe 2 to 3 times a week on a live stream. We can kind of go over names that are really being discounted. Okay, we'll use this as an example, right? What's a company that's really been selling off that's actually starting to get interesting is Nike, right? So we could put Nike up there. Now, I already did an analysis on Nike, and I think $66 is a really good opportunity for Nike, okay? $66 factors in, you're still paying a little bit of a premium, but the company has a ridiculous moat and still has growth prospects down the road. So that's kind of just something I'm putting together in the back of my mind. I really think it would be people that are really committed to the channel, people that are really wanting to learn how to invest. Not only will we talk about these stocks that could be presenting opportunities, but I will be able to break down the stock with the technical side of it. Probably not as good as most, but basic technicals. And then the fundamental side of it. What are they getting on return on investments? What are they getting on return on equity? How does the balance sheet look? Where are they looking to possibly make mergers and acquisitions? What is the balance sheet going to look like when they make these mergers and acquisitions? So there's different things like that we can kind of break down together. And so that's something I definitely would like to do going forward, if that's something you guys are interested in. The only thing I ask is that you subscribe, smash the thumbs up on this video so we can get it out to more people. And it would be great to have 20 plus people at every live stream, because the more people we have in there that are serious about investing, and the more people that are serious about diving into the numbers and really turning over these rocks to find some gems, the more opportunity we will have to find them, right? I can't be doing it all by myself. And then what that'll allow me to do is, when we do find some of these gems, I can actually create content on it and put it out there so people can get a better summary of what we found, right? So just some thoughts that I had. Hopefully everybody enjoys this. I know just kind of want to go over what's going on. Definitely a crazy, crazy market. I believe we are in a very euphoric stage of the market. And so even more so, I want to find these deeper value type names that are substantially cheap. That'll even lend a better buying opportunity if the market does correct and they end up dipping with it, right? So as always, guys, really appreciate everybody's time. Thank you so much. I really appreciate all the new subscribers, appreciate all the support. Hopefully you guys are finding value in what I'm bringing. And as always, guys, if you don't have the time to do this, I would only recommend investing in a handful of names and just dollar cost averaging into a broadly diversified index. Set it and forget it. And depending on how much time you have to actually put into diving into stocks, I'm hoping that this live stream could fast track that for you, so you can buy, you can take a little bit more risk on a few different names if things meet your criteria. Okay, this is not a recommendation to buy or sell, but might help you to kind of fast track your way into finding opportunities within the market. As long as we work as a group, I'm willing to do the legwork. So as always, guys, really appreciate your time, and thank you all for joining in. We will see you in the next one. Peace.